Hello again. Welcome back to my video series for Hospitality Intelligence and Analytics course. Today, we are going to explore a crucial topic for anyone in hospitality and tourism, pricing and revenue management analytics. Now, think about this. When a retail store doesn't sell a product today, they can keep it on the shelf and sell it tomorrow. But in our industry, things works differently. A hotel room, for example, that remains empty tonight is a lost revenue that can never be recovered. You cannot store that hotel room and try to sell it tomorrow. When it's gone, it's gone. The same applies to an unsold airline seat or a restaurant table that sits unoccupied during peak hours. This is why pricing and revenue management are not just financial strategies, but they are survival tools. In this session, hopefully we are going to learn why strategic pricing matters and how it impacts business performance, the role of revenue management in maximizing profitability through data-driven decisions, and how businesses leverage analytics to forecast demand, adjust pricing, and optimize revenue. Take hotels, for instance. Many rely on dynamic pricing, meaning room rates fluctuate based on demand, competitor pricing, and even external factors like weather, local events, or holidays. Now, airlines and hotels pioneered this approach, but now restaurants, event venues, and even theme parks using revenue management principles to boost their profitability. So, hopefully we are going to focus on these topics and learn about them. Now, that we understand why pricing and revenue management is crucial, let's define what revenue management analytics actually means and what it covers. Now, at its core, revenue management analytics is about using data to make smarter pricing decisions. It's not just about setting prices, it's about the forecasting demand, understanding market trends, and responding in real time to customer behavior and competitor strategies. So we can break down into three key areas. First one is the data-driven pricing strategies. Pricing isn't a guesswork. Businesses use historical data, customer behavior, and external market conditions to determine optimal prices. For example, hotel chain doesn't just set rates based on the last year's prices. They consider past booking trends, what was the competitor rates at the time, seasonality, even local events like something going on around the property to adjust rates dynamically. The second part is the demand forecasting and competitive analysis, right? So hotels, restaurants, and airlines must anticipate demand fluctuations. Will occupancy be high this weekend? Should a restaurant increase its prices before major sport events? Businesses use many tools, for example, for hotels, like booking pace analysis, pickup trends, even economic indicators to make informed decisions. And also price elasticity and segmentation-based pricing is important. Not all customers are willing to pay the same price. Some are price sensitive while others value convenience and experience over cost. Airlines do this well. Economy tickets are cheaper, but business travelers booking last minutes are charged a premium. Hotels, restaurants, and even theme parks use segmentation-based pricing to maximize revenue from different customers groups. By leveraging these approaches, businesses can maximize revenue while keeping their prices competitive and attractive to the right customers. Let's talk about real driving force behind revenue management. Data. Without the data, pricing decision would be based on gut feeling rather than real insights. Imagine a hotel manager setting room rates just by guessing how busy the weekend will be. That approach wouldn't work in today's competitive market. Instead, business rely on data-driven decision making to optimize pricing, maximize revenue, and improve customer satisfaction. So why data is important? First is the data-driven decision making, right? So data allows business to anticipate demand, analyze booking patterns, and adjust pricing dynamically. For example, if past data shows that demand spikes during a local festival, a hotel can raise rates in advance rather than react last minute. So you already know that local festivals, how is the local festivals going to affect your business? Restaurants use data to track peak dining hours, menu item popularity, and customer spending habits to optimize pricing and promotions. The second is the impact on revenue maximization and customer satisfaction. The goal isn't just to maximize revenue, it is to do so while keeping customers happy. Airlines are a great example, right? We gave an example earlier. They use yield management to ensure their flights are full, but they also have to balance pricing so customers still feel they are getting value. Hotels and restaurants personalize pricing using loyalty programs, special discounts, and targeted offers based on customer behavior, keeping guests engaged while optimizing revenue. Third thing is the reducing pricing risk and inefficiencies. Poor pricing decision can lead to a lost revenue or unsatisfied customers, right? If you make it very low, you can lose revenue. If you make very high, you might not even have a customers, or even the ones comes might not be satisfied. So data helps to find this sweet spot. So restaurants also use pricing analytics to determine whether many prices align with demand trends and cost, preventing losses from underpricing. To sum up, the pricing without data is like flying blind. Successful business don't guess, they use analytics to make informed strategic pricing decision. Now, we will look into how revenue management has evolved, what kind of things changed with the technology. Now, pricing strategies in hospitality and tourism have come a long way from fixed rates to today's AI-driven dynamic pricing. Let's take a quick look at how revenue management has evolved over the years. Initially, what we call the static pricing models, pre-80s, in the past, businesses relied on a fixed pricing models, where room rates, airline tickets, and restaurants prices were set seasonally or annually. I mean, many countries in the world, they are still doing this. Right? They decide from I'm just making up, January to March is going to be $100 a room. These decisions were based mostly in historical trends and intuition without real-time adjustments. There was very little flexibility, and if demand suddenly increased or decreased, businesses couldn't adjust their prices dynamically. Now, 80s to 2000s, yield management started, and also automated revenue management systems came. Now, just to tell you differences, the airline industry revolutionized the pricing with yield management. That's how it started, and they called it yield management, which allowed them to adjust prices based on demand, time of booking, and availability. And hotels and restaurants quickly followed, adapting yield management called revenue management to optimize pricing and increase revenue. This era also saw the rise of online travel agencies like Expedia and Booking.com, making price transparency a game changer. And 2000s to present is AI and big data driving pricing strategies. Today, AI and machine learning enables business to make real-time pricing adjustment based on the demand forecast, like competitor rates, or like we talked about this before, even the external factors, weather, local events. Now, more than that, AI-powered revenue management tools allows businesses to personalize pricing based on the customers themselves, like customers' behavior, their loyalty, booking patterns. Now, pricing isn't just about reacting to demand. It's about predicting it and staying ahead of the competition. The key takeaway is pricing has evolved from guesswork to a data-driven science. Now, that we have covered how pricing strategies have evolved, let's talk about how we measure their success, right? We talked about this before. If you cannot measure it, you cannot do anything about it. You have to measure it first. In revenue management, we don't just adjust prices and hope for the best, but we use the key performance indicators, KPIs, to track revenue, profitability, and efficiency. Let's not forget, these are only few of them. It's not all of them. On the slide, you will see like graphs and formulas for most important revenue-based metrics. So let's go through them one by one. First one is the RevPAR, revenue per available room. One of the most critical metrics in hotel revenue management. It's calculated as total room revenue divided by the available rooms. Next one is the GOPAR. Okay, GOPAR is the gross operating profit per available room. Unlike RevPAR, GOPAR considers operating costs to show true profitability. It's calculated by gross operating profit divided by available rooms. One of my earlier research, actually, if you look at the differences between RevPAR and GOPAR, especially for the smaller properties, RevPAR and GOPAR is very close. So RevPAR is, the reason I am making a difference because it's extremely easy to calculate the RevPAR. You can calculate day to day, but calculating the GOPAR is require a little bit more time, a little bit more information. So comparing this, RevPAR is very good, still very good indicator for the performance. I just want to point out that. Next one is the ADR, average daily rate. That measures the average price paid per room sold and is calculated by total room revenue divided the room sold. Okay, so you get the average rate for each room. Next ones are for the restaurant industry, what we call the RevPAR, revenue per available seat hour. Hotels aren't the only one using revenue management, right? Restaurants do too. So that's why we use this kind of calculations. The formula is the total revenue divided by the available seat hours. And the next one is the average check. This is for the restaurants and food and beverage outlets. This is similar to ADR, but for restaurant, it measures average customer spend per visit. And formula is this, as you can see, is total food and beverage revenue divided the number of customers served. In revenue management, understanding demand patterns is just important as setting the right prices. To do this effectively, we track key demand metrics that help predict occupancy, customer behavior, and booking trends. On this slide, you'll see the formulas and for four key demand metrics that businesses use to make data-driven decisions. The first one is the occupancy rate. This is one of the most fundamental metrics in hotel revenue management. For example, this is basically room sold divided by the total available rooms. Example is for example, there is a 200 rooms, hotel has a 200 rooms and sell 160 for the night. So occupancy rate is 160 by 200, which is the 80%. Okay, booking pace or curve measures the speed at which reservations are made leading up to a specific date. Just to give you a basic example again, if a hotel expects 300 bookings for an event weekend but has received 100 bookings a month in advance, the booking pace is 40%. But usually this is used with a little bit more complex calculations, especially with the curves. I'm a member of a dissertation committee, and one of our students working in the more complex methods of getting these curves and how do they relate to each other. But this is very important also if you can use it. Next one is the cancellation rate, the percentage of reservation that are canceled before the stay or visit. It could be used for hotels or the restaurant. But like for example, you received 200 bookings, but 40 of them are canceled. The cancellation is at 20%. Or restaurant for the table cancellations. Table turnover is very important in restaurant. This metric measures how efficiently a restaurant utilizes its seating capacity. Just to give you an example, if restaurant has 50 tables and serves 200 customers during a dinner shift, that's a turnover rate is 4 per table. When I say 200 customers, 200 times tables been turned. So each table turn 4 times during a certain time. Why this is important? And think about like just to give you an example. This is of course extreme example, but if each customer group comes and sits in your table, and they eat but they talk and have a conversation and etc. and spend 2 hours in versus there are people comes almost eating the similar foods but leaving in every 30 minutes, and assuming there's enough demand. So in first case you served only one time, get the same money. In the second scenario you got the 4 times more money because it's been every half hours the table turned. It's just a basic example. So far, we covered revenue-based metrics and demand metrics, but as I told you before, revenue management involves many other performance indicators. I just want to give you a few additional metrics. But once again, let's not forget, these are just examples. There are many more depending on the business type, objectives, and whatever you want to achieve. So you have to be careful and not specifically focusing on these, but in your own business. First one is the contribution margin. Measures how much profit is generated per unit after variable costs are deducted. Help businesses to understand how much each room, table, or service contributes to covering fixed costs and generating profit. This is very critical for identifying high margin services and adjust pricing strategies accordingly. The second one is the net revenue per booking channel, considering all these OTAs and other channels. So this metrics tracks the revenue generated from direct bookings, from the OTAs, or even in the OTAs in different agencies, corporate contracts, and many other channels. So you can look at it and see what's the net revenue per booking. I don't want to get into too much details. I discussed this in my revenue management class, but just give an example here. Length of stays is the average duration guest stays at the hotel. Longer stays typically results in a higher overall revenue and lower operation cost per guest. You can use this LOS-based pricing strategies such as offering discounts or for extended stays. There is also market penetration index. Compares a business's occupancy performance against competitors in the same market. If MPI is greater than 1, or sometimes called occupancy index as well, but if it's greater than 1, the hotel is capturing a larger market share than its competitors. This should be combined with the pricing and marketing strategies to evaluate the competitive positioning. Revenue generation index, or RevPAR index, compares the hotel RevPAR performance to competitors. Similar to above, usually is measured with the 100. More than 100 means the hotel is outperforming competitors. 100 is about the same level, and if it's less, you are doing worse than relative to your market. Like I said, these are just a few examples. Now we discussed the pricing strategies, demand forecasting, etc. But all of these rely on high quality data. Without reliable data sources, even the best algorithms and revenue management system would fail to make accurate pricing decisions. On this slide, I just divided into three key categories of data sources that businesses use to refine their revenue management strategies. The first is, of course, always the internal data sources. These are data points collected directly from hotel, restaurant, airline, and your business, offering valuable insights into past and current performance. Where this data comes from, like property management system. Those are stored historical booking trends, room rates, and occupancy data. Point of sale systems in restaurants track menu item sales, customer spending behavior, peak service times. It depends on how complicated your systems are. Customer relationship management system provide guest history, loyalty data, and past spending patterns. And like how is used is for example, historical data from PMS is fed into like forecasting model to predict future demand, or POS data could help restaurant to adjust menu pricing based on sales trends and demand fluctuation. And CRM insights allow for personalized pricing and targeted promotions. There are also market data sources, right? These provide insights into competitor pricing, industry benchmark, and broader market trends. There are many, but these are once again some examples. Like there's a competitive rate shopping tools, like from the company called STR in hotel industry. We get a lot of data from them, or OTA Insight. These track real-time pricing for competitor hotels and restaurants and other places. Especially the online travel agents, OTAs, like Expedia and Booking.com, provide insights into booking behaviors, cancellation patterns, and guest demographics. There are also meta search engines like Google Hotel Ads, Kayak. They aggregate price comparisons, helping businesses to adjust rate dynamically. Once again, like I said, STR, Smith Travel Research reports help hotels to benchmark their performance. Those RevPAR index, occupancy index, etc., everything comes from STR and compare with your competitive set. And like I told you, OTAs and meta search engines also bring a lot of insights. Of course, this is also part of the external data sources, but I separate it as an external data sources because businesses don't just look at the internal and their market data, but they also measure events like major external factors. For example, macroeconomic indicators, right? GDP growth, inflation, exchange rate influence travel spending and tourism trends in the long term. Okay, especially in our industry, customer behavior is affected by this, like how much disposable income they got, for example. There is also seasonal and event-based data. Major concerts, sports events, conferences can create temporary spikes. Weather forecast and local conditions also important. Bad weather may increase room cancellation, while sunny forecast can boost like last-minute bookings if you're a beach property, for example. Okay, I just want to also talk about we understand the key metrics. We'll talk about some of the measurements, some of the databases. I just want to also talk about some of the statistical techniques that could be employed in this kind of analytics. Now, revenue management isn't just about tracking numbers. It's about using advanced analytic methods to predict demand, assess price sensitivity, and benchmark against competitors. I also put this into three major categories, but like I said, these are not the techniques. These are just some examples. Okay. For example, in demand forecasting models, businesses use forecasting to predict high and low demand periods, allowing them to adjust prices strategically. Time series analysis and moving averages helps identify trends and seasonal fluctuations in the booking patterns. AI-driven predictive models, which becoming more and more advanced, leverages machine learning algorithms like more advanced regression model or neural networks to detect demand patterns based on the historical data and external factors. Uh, Pickup models and booking curve analysis use cumulative booking data to estimate final demand, ensuring pricing is optimized before the stay event and date. Many of my researcher friends actually is worked and currently working in this, how this booking curve analysis could be implemented more carefully in our price analysis. So statistic techniques in this case, for example, ARIMA, autoregressive integrated moving average, predicts future demand using past data patterns. If you are interested in, for example, this kind of things, the US government created a tool called X13. I guess is the latest version is X13 as of right now. You can download that and use it in your forecasting calculations, and it's not that complex program to use. Exponential smoothing gives more weight to recent data points to make short-term demand forecast when you do the demand forecast. I'll give some examples in my other videos. And neural networks and XGBoost, these are some AI-based models that improve forecasting accuracy. Now, another kind approach is the price elasticity analysis. Price elasticity of demand measures how sensitive customers are to price changes. If demand drops sharply after a small price increase, the product is highly elastic, right? We also use conjoint analysis for pricing decision. This kind of analysis helps business to understand how customers trade off price versus other attributes like amenities or services. We did this kind of analysis before, A/B testing, if you recall from earlier analysis. But it could be used also for price optimization. You can experiment with different pricing structures and observe customer responses before rolling out permanent changes. So for this kind of analysis we can use price elasticity coefficient calculations to determine the percentage change in demand for a given price change. There is one Westendorp price sensitivity model that helps the businesses to find optimal price range that customers perceive as fair. There is also a Granger method that surveys potential customers at different price points to estimate their willingness to pay. And last thing is the competitive pricing and market positioning. Businesses don't set prices in isolation. They must monitor competitive pricing trends and position themselves accordingly. So one of the things we use is the competitive rate benchmarking, right? This helps businesses to compare their prices against similar competitors in the market. Market share and revenue generation index we talked about this measure whether businesses are performing above or below the market average in their competitive sets. STR and OTA intelligence reports provide pricing insights across competitive sets. This helps the business adjust pricing based on the real-time market conditions. Now, there are also, for the competitive pricing and market positioning, there are some statistical techniques used. First one is once again, these are just a few examples. Market basket analysis that's help understand the purchase behaviors and how different pricing levels impact revenue. Next one is the regression analysis. This basic regression analysis or multiple regression analysis. This identifies the key factors affecting demand, like competitor pricing or seasonality. I'm gonna have more example on the especially demand part for regression. Cluster analysis is the group similar. Similar to we did in the marketing and the customer analytics, right? We have the clusters, we have a groups. So the cluster analysis groups to similar customers based on pricing sensitivity and purchasing behavior specific. Talking about specific, that is pricing and revenue management analytics. Now, there are a few examples, a little bit more advanced examples. In the previous slides, we covered, how businesses forecast demand and analyze pricing. But this is more of how they make strategic decisions in real time. The first one is the dynamic and personalized pricing. Modern pricing strategies are no longer static. They adjust in real time. They are dynamic. they are based on customer behavior, demand patterns, and competitive conditions. If they can get the data real time. AI-powered dynamic pricing models use machine learning algorithms to analyze demand and adjust rates automatically, ensuring maximizing revenue at all times. Personalized pricing is getting more and more advanced. Use customer segmentations. As a matter of fact, not only customer segmentations, they start to use even an individual person, like a specialized price. They tailor prices based on the like customer history, preferences, and loyalty programs. Geo-based and mobile pricing strategies, they adjust prices based on customer's location or device. Offering, like for example, offer special discounts to user booking through mobile apps or targeting specific regions or promotions. There are a few statistical techniques used, like reinforcement learning and price optimization models. AI or machine learning continues to learn from pricing performance and refines pricing recommendation. This is similar to what we talked before, cluster analysis and customer segmentations. It helps group customers based on their bookings behavior and price sensitivity. Regression and demand-based pricing adjustment analyzes price response to data to determine optimal pricing strategies for different segments. And next one is the revenue optimization and in inventory management. Revenue management goes beyond just pricing, like we talked about this before. It involves optimizing inventory and available resources to maximize profitability. So, like for example, we just actually published one paper about two papers about the overbooking, but overbooking is used extremely in our industry, and you have to be also careful, right? If airline industry, and you don't want to go to airline and they say, oh, we are overbooked, and you need to wait for the next line. So that's why it's important to have a very good strategies. But the overbooking and capacity control strategy ensures that perishable inventory, they use in a way that is fully utilized while minimizing the risk of empty space due to cancellation. So if you were able to measure it exactly, like you have a 300 seats in your airline, right? And exactly 10% is going to miss. So which means 30 people, you can sell additional 30 people. But if you make a mistake and if you sell 35, that 5 people is going to come to your check-in desk is going to be very disappointed because you overbooked. So that is why it's important. So bundling and discounting strategies encourage customers to purchase multiple services together, such as hotel plus spa packages or meal plus entertainment bundles. So some of the statistical technique used, optimization algorithm for overbooking, uses past cancellation data to determine the safest level of overbooking. And market basket analysis for bundling helps businesses identify which products, services are frequently purchased together. And logistic regression for upselling probability predicts which customers are most likely to upgrade based on past behaviors. We also have a scenario analysis and decision support models. Businesses don't just react to pricing trends. They simulate different pricing scenarios to make informed strategic decisions. What we use is for example, what if analysis for pricing allows businesses to test different pricing models and evaluate potential revenue impact. Monte Carlo simulations for revenue risk analysis is analyze thousands of pricing possibilities to estimate potential gains and losses under uncertainty. And optimization under uncertainty helps businesses to set pricing strategies even when market conditions are unpredictable. So once again, a few of the statistical techniques used here is the Monte Carlo simulations. This method uses probability models to predict potential revenue outcomes based on the different scenarios. And stochastic optimization models helps businesses to optimize pricing and inventory allocation when demand is uncertain. And multi-objective decision modeling is another method. It's called helps to balance revenue, occupancy, and customer experience in the pricing decision. Once again, I didn't want to get in too much complicated and get in too much details, but these are few of the examples, especially in the advanced level, could be used for this kind of analysis. So see you next time. Thank you for watching.